Kit, good evening to you, and thanks so much for staying late with us. It sounds like we're in for a volatile 10 days now before February 1st. How bumpy do you see things getting?
Possibly chaotic, possibly just kind of bumpy in the sense that we people say things and then we move, and then someone says something different and we move back. This is, I don't know if it's a game of chess or a game of something, but it's a negotiation, these trade talks. I will do this doesn't mean I'll do this. It means I'll do this unless you do something. And so you say what you're going to do, I say what I'm going to do, you say what you're going to do, and we end up down the road at a position that isn't that we're comfortable with. And so we shouldn't take any of the opening rounds as kind of gospel in that sense.
We shouldn't take it as gospel, but the currency markets will move on it as well. At what point do you think, as we get closer to February 1st, some of this noise will start to die down, or will it kind of reach fever pitch by February 1st?
I think it'll probably continue beyond February the 1st in practice, just because of, by February the 1st, we will have made some progress and then the goalposts will have moved a little bit. But I don't think we'll have solved the whole issue. I mean, one of the things is, if someone comes in with a hard and fast tariff move, you put in a 25% tariff, then the person who takes that tariff either raises prices to compensate for it, or comes back with their own tariff to you, tit for tat sort of move, and then the first country then has to react, or we have to sit down and have a conversation. So the whole process can get very long, very drawn out and very complicated. There are two things I think though that we have to remember at the back. I mean, firstly, by and large, tariffs are something nobody wins from. Mm-hmm. And the second is that, well, maybe three things. The second is that if you impose tariffs on me, I'm not going to cut the price of what I sell, what I'm exporting to you.
Right.
So the prices go up a little or a lot, and so that is, it's not disinflationary, mm-hmm. and that's important. And the third thing to remember is the United States is doing this against a backdrop of very nearly full employment, which means if the idea is to get jobs, most people who want a job in the States have got one. So we have to find people for the U.S. to benefit.
So, Kit, the latest CFTC data on FX shows that there's a huge net long position in the U.S. dollar. To what extent does that reflect the dollar strength versus drive the dollar strength?
Well, it reflects the dollar strength. It reflects, a decade of U.S. exceptionalism, of U.S. stronger growth, of higher U.S. rates, stronger U.S. growth, less regulation in the United States in a bunch of ways. I mean, you shouldn't knock how good the last decade and then some has been for the U.S. dollar. What we've got, though, now is there's a big, long position, and there's an even bigger position in terms of net foreign investment into the United States. The world's biggest savers, people like the Germans and the Japanese and the Swedes and the Norwegians, they have been buying U.S. bonds, U.S. equities, U.S. everything for the last few years because they're just doing better than any investment they could make at home. Mm-hmm.
So that's that U.S. exceptionalism you're talking about. That and monetary policy divergence are really driving the dollar. And of course, a lot of people say it's already reflected in the price of the dollar as well. Still, we know that markets do tend to overshoot. How much stronger can the U.S. dollar get from here?
It can get stronger. Look, my very first job in 1985, I asked the head of the German Bundesbank how high the dollar could get in that big run-up under President Reagan. The smartest guy I knew at that point said, "Kid, I haven't got a clue. We intervene every day. It goes up every day." So I learned as a 20-something-year-old not to try to be too clever on this. I think we're much nearer the top than when you go out of the bottom or the middle or the average or the destination. There might be a little bit more. The danger is, U.S. assets have done so well, so much money's flooded in, is that when it turns, soft landing the dollar is not going to be that easy, because if people start pulling money out, that can very easily become a flood.
Right, something to keep in mind here. As we look ahead, Kit, at the end of the week, the BoJ will be holding its meeting, and of course, there are all kinds of signals that the BoJ will hike by 25 basis points after not doing anything in December and choosing to wait and see what the Trump administration does. What do you think the BoJ has seen in day one and now day two that makes it comfortable with hiking now?
I think, firstly, they're not seeing the yen strengthen too quickly. And one of the problems of the yen moving from 100 yen to a dollar, to 165, was that when they started moving rates, we came back to 140 quite quickly. And that's really uncomfortable because that's disinflationary just then when they're trying to escape it. I think that now they've confused the market enough that the yen is moving very slowly stronger at best. And the fact that the dollar's quite strong still sort of gives them room to act. And the yen might not rally too much, particularly if U.S. Treasury yields start moving higher again at any point.